Greg, you say that all the good news for 2022 is in the market right now and that the optimism is misguided. Why so blue, my friend?
Well, look, I certainly think that we are pricing in a best case scenario. I think this rally is built on the sentiment that things are improving in the Russia-Ukraine conflict. I would probably differ from that view. I think the current levels we are seeing reflects that the Fed raised the rates, and now we don't have to think about that anymore. But we have 7 more increases to come. And so I think what you're seeing around the street is people are slowly taking their estimates in. Goldman cut its S&P, BNP Paribas cut its S&P, other notables have, because I think consensus is coming to see that we are going to have a significant corporate earnings growth deceleration this year. And in an environment where we're having corporate growth earnings deceleration, and in an environment where the Fed is tightening, we're not going to get multiple expansion. And I think that there's further downside risk to where I'm at, even because I'm at low single digits on what I see as growth this year in terms of corporate earnings growth, because of the many headwinds that we're facing, because of the many headwinds we're facing on the bottom line and the top line. But there's even further risk down. With $112 barrel oil, if the Department of Energy is right, and we're going to average $112 over the second quarter, with a tightening Fed and a flattening yield curve, that's a prescription for recession. Now, I'm not there yet at low single digits for S&P, but the likelihood that we dip into recession far outweighs the likelihood that there's an upside surprise to the low teens or 10% growth that the consensus is expecting.
So take it all together, and you've got slowing earnings growth. You've got rising interest rates, which probably in and of itself depresses the multiple that people are willing to pay for stocks. You've got rising energy prices and high inflation. And yet, I just began by saying that the S&P and Dow are having their best week since 2020. Well, where's the disconnect here? Are investors just suspending disbelief?
Look, I just think that there's optimism that we've gotten past some of the overhangs without recognition that there are many more yet to come. We have not yet talked about the fact that global debt to GDP is 350%, far above where it was before the last crash/recession, which was at about 290. We have not yet talked about the fact that the ECB has stopped buying bonds as well and are reducing their balance sheet. And yet, some of these countries, Italy is at 155% debt to GDP. They're going to need to issue more bonds. Who's buying that? So we haven't talked about the risk of a foreign default. We haven't talked about BA2 spreading clause enclosures in China and how that's going to intensify. So the risks are decidedly to the downside to even my mid to low single digit outlook for the S&P this year. And if that's right, I'm going to dimension it for you. If that's right, typically a recession has led to about a 30% reduction in earnings. And if we take the $55 from last year, project that to be, with mid to single digits around 240 this year, and take a 30% haircut on that, that puts us around where the S&P closed in 2019. Right? Okay. It puts us at about 160 of earnings with a 20 times multiple. That's a far cry from where we are today. And again, I'm not necessarily calling for that, but if energy continues to
We have to leave it there. I'm sorry to interrupt you, Greg, but I do, for the record, want to point out that at the point at which you come back on here and say now's the time, you like some of the big tech, blue chip, big cap companies, you like some of the cybersecurity companies and the payment companies, Visa and MasterCard. Greg Branch, thanks very much.
Durable earnings growth.
All right,
thanks,
you got
guys.
it, man. Thanks.